Hello and welcome. Today, we are going to unlock one of the most powerful and honestly, one of the most straightforward ways to build real wealth on the Nairobi Securities Exchange. We're going to talk about building a system that actually pays you just for being an owner. All right, let's dive in.
Really think about that for a second. What if your money could start building its very own money-making machine? A machine that rewards you simply for owning a piece of Kenya's biggest and best companies. Well, that's not some far-off dream. It is the real power of dividend investing, and we are going to break down exactly how it works for you. So what's the fuel for this wealth machine we're talking about? Well, it all starts with one simple concept, the dividend. And understanding this, really getting it, is the foundation for, well, everything. And it really is that simple. You see, when a company you've invested in makes a profit, they can decide to share a slice of that profit directly with you, the shareholder. You can think of it as their way of saying, hey, thanks for being a part owner of our business. And that right there, that's the magic. You don't have to sell your shares to make a return. Nope. Just by holding on to them, you can get regular cash payments sent right to you. This is pretty much the textbook definition of passive income. And listen, this isn't some abstract idea that only happens on Wall Street or something. We are talking about household names right here in Kenya. You know them. Companies like Safaricom, KCB, Equity, these are huge, established businesses with long histories of rewarding their investors. Okay, so getting a regular check is great, for sure, but that's just step one. The real power, the thing that gets exciting, is when you let that money start growing all by itself. This is where we get to see the amazing power of what we call the dividend snowball. This is the engine of your wealth machine. It works like this. You buy some shares, the company pays you, and this is the most important part, you take that money and you reinvest it to buy even more shares. So now you own a bigger piece of the company, right? Which means the next dividend payment is even larger. You reinvest that, and the cycle just keeps going. Over years, that little snowball you started with starts rolling downhill, and it just gets bigger and bigger and faster, all on its own. Okay, so the idea is pretty clear. But how do you actually find the right companies to build this snowball with? You can't just pick any stock. You need the right tools. So let's open up the toolkit for becoming a smart dividend investor. Look, if you only learn one metric from this whole explainer, please make it this one, dividend yield. This simple little percentage tells you exactly how much cash you're getting back for every single shilling you invest. You can almost think of it like the interest rate you're earning on your shares. And don't let the formula scare you off. It's actually super simple. You just take the total dividend the company paid for one share over the whole year, divide that number by what it costs to buy one share right now, and then you multiply by 100 to get that nice, clean percentage. And here's a perfect example of how it works in real life. Let's say a share costs you 40 shillings, and over the year, that company pays you 2 shillings back in dividends. Well, that means your dividend yield is a solid 5%. See, this number makes it really easy to compare the income potential of different stocks. But, and this is a big but, a high yield by itself can sometimes be a trap. What you really want is stability. So this checklist is your guide. You are looking for predictable, maybe even kind of boring businesses, the ones with consistent profits, not a lot of debt, and a long proven history of paying people just like you. All right, so now you know how to pick a single stock. That's great, but you really don't want to put all your eggs in one basket. The real strength comes from putting together a diversified portfolio, your complete dividend machine. What you're seeing here is a really important idea, safety through diversity. By spreading your money out across different types of industries, like banking, telecoms, and manufacturing, you build a kind of financial shield. If one sector has a tough year, the others can keep your income machine running just fine. This is what financial resilience really looks like. Okay, and this is where the whole strategy becomes personal. It's not just about investing for the sake of it. It's about hitting a specific target that matters to you. So the big question is, what's your number? How much passive income do you actually want to earn every year? What's cool is that you can actually work backward to figure out your target. Let's say you want to earn 100,000 shillings a year from your investments, and let's assume your portfolio has an average yield of about 6%. Well, you can calculate exactly how much capital you need to get there. This turns a vague dream into a clear, tangible goal you can start working toward. So we have the theory, we have the tools, and we have a plan.
But you know what? None of it really matters without the final and honestly, the most crucial piece of the puzzle, the right mindset. This is what truly separates successful long-term investors from, well, from everyone else.
First things first, forget about the hype. This is not about chasing those skyrocketing stocks you hear about in the news. Your goal is totally different. It's to own solid, reliable businesses that form the backbone of our economy, not to buy lottery tickets. Second, you absolutely must avoid panic. The stock market will have bad days, it'll have bad weeks, even bad years. That's a guarantee. But you're not a day trader glued to the screen. You are an owner and you are just collecting your income. A market drop is just a sale, a chance to buy more shares at a discount. And finally, there's no rush. You know the story of the tortoise and the hare? That is the perfect way to think about dividend investing. This is not a get-rich-quick scheme. It's a get-wealthy-for-sure plan. Your greatest superpower here is patience. Seriously, every single year you stay invested, that dividend snowball gets a little bigger, and your wealth compounds more and more powerfully. Time is the ultimate fuel for your wealth machine. And that really just says it all, doesn't it? It's about letting these solid Kenyan companies go to work for you, day in and day out. It's about building a system that pays you for your patience. So the only question left is, are you ready to put that secret weapon to work?